Hi, my name is Rich Stang. I'm a CPA and tax advisor for Northwest Tax Group, a subsidiary of Northwest Federal Credit Union based in Herndon, Virginia. In this brief video, I'm going to highlight some of the key changes that occurred with the passing of the 2017 Tax Reform Bill, since many of you are still uncertain about how these changes impact you. If you have specific questions or need extra help, we are available to assist you with tax preparation and planning in our Herndon office or at any Northwest Federal branch. Feel free to make an appointment by visiting nwtgllc.com and completing the form on the Contact Us page. I'm going to start by covering the current tax brackets and rates. One of the big changes in the new tax law is that the tax brackets have been reduced, the rates for those tax brackets, and the income in each of the brackets has been expanded. This is a little bit obscure, but this is where most people are going to see a tax decrease because rates are lower and the income that falls within each of those rate brackets has been increased. One thing I would like to point out about rates, everyone gets worried when they're climbing through the 22% bracket or the 24% bracket, thinking that all of their income is taxed at those rates. Our tax system it always has been progressive, where you pay 12% at one bracket, then you pay 22% on the next piece of income. So while it is important to know what your tax bracket is, it isn't necessarily true that you're paying that same rate on all of your income. One of the other big changes is the increase in the standard deduction. So for single filers, the standard deduction is now $12,000, and for married filing joint couples, that standard deduction is $24,000. Also, the personal exemptions have been eliminated. What we're going to see with the expanded standard deduction is many more people are going to use this standard deduction and not itemize. The estimates that came from the IRS were that where 43 million filers had used the itemizing before, now only about 10 million will be itemizing. The next item is the child tax credit. We have always had a child tax credit for those children under age 17, but the credit has now been doubled. So whereas it was $1,000 before, it is now $2,000. Now many people in our area here were phased out of that credit. That item phased out at income above $110,000 if you were married joint in the past. However, now the phase-out doesn't start until your adjusted gross income equals $400,000. So in the projections that we've been running, we have many more clients who are going to benefit from this child tax credit, and it's going to be twice what it was in the past. For those of you who have children over age 17 or older, or maybe have dependents that aren't children, like parents, for instance, that you provide support for, there is a credit of $500 per dependent for those that don't qualify for the larger $2,000 child tax credit. Mortgage interest is another change. While mortgage interest continues to be deductible, no change there, the cap on what your debt can be is now $750,000. That used to be $1 million, so they've reduced that to $750,000. If you have mortgage debt in excess of $750,000 on loans taken out after January 1st of 2018, then some of that mortgage interest may not be deductible. The ability to write interest off on two homes is still available as long as the total debt on both homes doesn't exceed $750,000. That may impact a few people, but I don't think it will ultimately impact too many. One item that will impact a lot of people in our area is that the ability to write off taxes is now limited. So we could always deduct real estate taxes, state income taxes and personal property taxes, that deduction is now going to be limited to $10,000 for all taxes. I'm going to come back to how itemized deductions may work for you in just a minute. Medical expenses still deductible. In fact, it's a little bit better than it was before. We were going to raise the threshold that said you could only write off medical expenses that exceed 10% of your adjusted gross income. That threshold is now 7.5% of adjusted gross income. For most of us that have decent medical insurance, most of us are not writing off medical expenses, but to the extent that you were close before when the limit was 10% of income, you might get a deduction now since that threshold has been lowered. I already mentioned the credit for non-child dependents of $500. Again, don't lose track of that for those people who are not your children or who are older than age 17 that are your children. This is a somewhat obscure provision, but the Affordable Care Act insurance mandate has been repealed. What all that means, and it's been repealed after 2018, so that's effective starting January 1st. Essentially, that means that there isn't a penalty any longer if you don't have health insurance. So that's the other provisions of the Affordable Care Act do still exist. One item I wanted to mention about itemized deductions. If you think about your own return, and I'm going to use a married filing joint example. If the new standard deduction is going to be $24,000, and we know that taxes are capped at $10,000, that means that if your mortgage interest is, say, $10,000 as well, and you contribute $2,000 or $3,000 to charity every year, that means that you won't be itemizing, you'll be using the standard deduction. We've been working with a lot of clients about their mortgage. If the mortgage interest is really not going to give them a tax benefit because they're otherwise going to be using the standard deduction, we're now talking to more people about paying off their mortgage early. Also, if you're retired and you're now taking required minimum distributions from your IRA, there is a provision called the Qualified Charitable Distribution that says that you could send some of your required minimum distribution directly to a charity, and that part of the distribution would not be taxable to you. So if you're otherwise going to be using the standard deduction, it is in your best interest to send, and you want to do a charitable contribution, it's in your best interest to send that payment through your IRA and not directly send the check yourself so that you'll get a tax benefit from that. A big provision for those of you that may have a business or perhaps do some consulting work is called the Qualified Business Income Deduction. Subject to a lot of different restrictions, mostly based on income, which I could cover separately for any of you that would like. There is a 20% deduction on your net income. So if you're a consultant and you're earning $80,000 from consulting income, a business, again, subject to a lot of other limitations, it is possible that you would get a $16,000 deduction, essentially only paying tax on 80% of your business income. So for those of you that have part-time consulting practices or other businesses, that is definitely something to be looking at. For the alternative minimum tax, the exemption has been increased. So for those of you at certain income levels, usually in the older law, somewhere between $225,000 and up, many of you may have seen the impact of the alternative minimum tax. Because of the changes in itemized deductions, as well as the fact that they've increased the exemption for the alternative minimum tax dramatically, the projections that we've run for a number of clients show that they will no longer be subject to the alternative minimum tax. So that's actually been a big tax savings for those that were previously impacted by the AMT. The estate tax exemption has doubled. So estates up to $11 million can be passed to your beneficiaries without any estate tax. Virginia doesn't have an estate tax, so that means if your estate is less than $11 million, your estate is both federal and state estate tax free. That is per person. So if you're married, that estate tax exemption is now doubled to $22 million, and that continues to be indexed for inflation as well. Lastly, as far as the provisions, the alimony deduction has been repealed after 2018. That means for any divorce that is finalized in 2019 or after, alimony will no longer be deducted by the person who pays it. It's no longer included as income by the person that receives it. I'm sure that those settlements will reflect that change, but that is a provision that I guess will help simplify the tax code a little bit. That covers the major changes that I think are important to most individuals. Remember that finding ways to be tax efficient is one part of the holistic financial strategy. Northwest Tax Group is a sister company to Northwest Financial Advisors, Northwest Insurance Agency, and Northwest Title and Escrow. And all of our teams work together to help you manage your financial life. If you would like a copy of our full tax strategies presentation, please email info@nwtgllc.com and we'll be happy to send it to you. Thanks for watching.